welcome to our quarterly DLP Capital dinner event. Great to see lots of familiar, friendly faces. Also great to see a lot of unfamiliar faces. So welcome everybody. To give you an idea, dinner's going to be served
the second mic will never work with the wall closed. He's on that one now. Right, so only when the wall's open.
After the presentation, a couple of housekeeping items. People in the back right now.
All right, good evening everybody. So before dinner comes out, which is going to be coming out in about 10 minutes, I'm going to get you guys all engaged here a little bit here. So I'm going to get you guys moving a little bit. So I'm going to be asking a few questions, and this is going to help us gauge the kind of pulse of the room, give you a feel for who's in the room, and really why we're in the room. So, all right, so I'm going to start off here. So if you're here for the very first time, you've never been at a DLP event before, please stand up. Yeah, if you guys are standing, just welcome. Welcome for the first time. So the other half of the room has been here before, so talk to them. They should be at all of your tables. You might want to stay standing. Stand up if you've invested money in real estate before. So if anybody, whether you're here for the first time or not, yeah, you have to. If you've invested money in real estate before. All right. So what we're talking about isn't that foreign to a lot of you. Many of you have invested money in real estate before, right? All right, so stand up if you're looking for a place to earn consistent returns and not lose money. I sure hope everybody's standing and that's why you're here. All right, good. All right, so now we're going to change chairs. So how many of you, and I'll give you a break here and let you raise your hand here. So how many of you have children or grandchildren to put through college? Quite a few of you. All right. How many of you have extensive plans to travel when you retire or if you are retired? There we go. All right. That's a pretty big amount of room. How many of you have financial obligations that are dependent on your wise investment choices? Most of you, right? How many of you have a favorite charity or project that you're passionate about that would suffer if you lost your financial security? Some of you? Okay. All right. Last couple ones here. I'm going to have you go back to standing here. So if you're an existing DLP investor, please stand up.
Is this exercise class?
It is. So round of applause for them, please. So hopefully you have them an investor at every one of your tables. These are our existing investors who've invested their money with us and come out tonight to show their support. And you might want to stay standing, existing investors. Stand up if you, and this is not DLP related, okay? Stand up, and this is for existing and everybody else. If you have lost money on any investment before. All right? Now everyone pay close attention to this one. Stand up if you have lost money on an investment with DLP. So that's why you're all here tonight, right? All right. So that's the last exercise for a little while. So All right, so we're going to get started here tonight. I'll move around the best I can. Hopefully everybody can hear me well. Dinner will start coming out in a few minutes. Please don't think you're impolite. Eat as we come around, and then we'll open it up to questions at the end. All right, so there's two keys to successful investing, I believe, in any investment. And if I can just ask you, you can feel free to walk around, grab a drink, and eat, but just try to be a little bit quieter, some of you. All right, so two keys to successful investing. Number one is the strategy, and number two is the execution on that strategy. So our strategy here at DLP, we have two strategies. Real estate investing, real estate backed lending, so making loans backed by real estate. That's our first strategy, making loans to active real estate investors. And our second strategy is buying multifamily or apartment communities. Those are the two things we do. Those are the two things I'll be talking about here tonight in that order. The ability to execute, that comes down to the manager. Who's in charge? Who's responsible for executing on that strategy? So that, in our case, is DLP Capital Partners. We're a vertically integrated operator. You're going to see what that means, all the different companies that we have. With, as of literally today, we broke 300 employees. We have 301 team members as of today. We had about 200 at the start of the year, to give you an idea. And then we run our companies on what we call the DLP Elite Operating System, which really helps us to execute and drive results, which you'll hear a little bit about that tonight. So why should you be interested in investing? I hopefully established that already here in the little exercise we did. You know, the fact that nobody has lost money with us, the fact that you all have needs to be financially secure, reasons for you to earn consistent returns and protect your money from risk. To break it into two different ways that you could invest with us, two things you should be interested in. One is investing as a fixed note investor. Our note investors earn 6 to 9% returns. Fixed, it's a locked-in fixed return. And our equity investors, depending on the fund, some of them are higher, but earn at least an 11% annual return. So you're going to hear a couple different strategies, but those are the two different ways you can invest, as a note holder or as an equity investor. Our rules or principles as we invest, first and foremost, hence why nobody was standing, we do not lose money ever. That's our first rule, that's our first focus, that's in good markets like today, and as we go into recessionary markets here in the future. Two is consistency in our returns. We've exceeded our return targets every period in all of our funds since any fund has been open. And third, generate the highest returns we can without risking consistency or principle. That's what we focus on doing. Those are our rules to investing. So what do we do? And when I say, oh, come on through. When I say we, I mean us and the 100+ investors who stood up who are actively invested with us. We invest in people and in turn in real estate. We mean, again, us and our investors. What the results of that are we have over 20,000 people right now living in safe, affordable housing that we own together. We support more than 200 entrepreneurs right now who we have loans out to, helping them buy properties, renovate them, and sell them. We provide jobs to, now it says 280, but as of this morning it was 301 now, team members, and support their families. And in turn, we generate consistent returns to all of our investors. In picture format of what I just described is there on the screen. Those are some of the homes that our investors have renovated and flipped, some of our happy clients that we've helped sell homes, homes that we've flipped and renovated, and many of our happy team members in those pictures there at our offices in Pennsylvania, here in Bethlehem, and in Florida. So a little bit about us. Somebody was just saying, it looks like you have a lot of different companies. We do. So those are all of the different DLP brands that all work together. When we say we're vertically integrated, that means we operate every area of how we invest. So we're the property manager, the construction company, the real estate brokerage, the lender. We operate the businesses that support our investments. So those are all the DLP family of companies. This is the executive team here at DLP, the executives who lead our family of companies. Some of these gentlemen and ladies are here tonight. Bob, our CFO, where are you at, Bob? Right here. Oh, there he is. So Bob, our CFO, yes, and partner in the firm. Matt John, I think I saw around here, our controller. Where's Matt? Right back there. Thank you, Matt. Jonathan Campbell and Nate and Brian are all here. Where's Jonathan, Nate, and Brian? Right here next to each other. Nate, Jonathan, and Brian's around here with a bow tie. There he is. I think that's everybody who's here. So those are some of the members of our executive team who drive our results across our family of companies. A little bit about myself, if this is your first time here. I've been in real estate now for, this is year 13. I've closed about 8,500 real estate transactions, including acquiring over 1,200 properties, including over 8,000 apartments and homes. Currently ranked as one of the top real estate professionals in the U.S. And I'm the CEO and founder of our family of companies. And we currently own over 8,000 homes and apartments, as well as over 300 loans, along with you as our investors. And maybe most importantly, and actually no offense to our investors, most importantly, I'm the father of those two little boys on the right, Donnie and Alex, who are with my parents right now, spending some time. And then my wife, Carla, is over here. Thank you. So at DLP, all of those companies I showed you a minute ago, all those people, we all focus around one purpose, which is passionately living our dream to create prosperity through innovative real estate solutions. That's what we do here at DLP. We create innovative solutions. That's how each of our companies was founded and how we perform and behave today, focusing on providing solutions. We have 8 core values that drive our activities, drive our hiring, drive our performance that you can see on the screen there. They're also in those handouts that you received. And I believe, as I said, our purpose is to create innovative solutions. I believe great companies, what they do is they solve problems. That's the job of a great company. Great companies are able to successfully solve problems more so than normal average companies. At DLP, as I said, everything we do revolves around solving problems. When we started, I started as a real estate agent, selling real estate. And we did not create the 10 different companies we own today because we set out to say, hey, we want to be a property manager. We want to be a construction company. We want to be these things. We set out to solve people's problems. So I'm going to I try to mix up and tell a little different story for those of you so it doesn't get stale for those of you who've been here many times. So that picture of that beautiful looking property there is a 10-unit apartment community in the Poconos. That was the first apartment community we ever bought of 10 units or larger. One of the first apartment properties we had ever purchased. This was back in, I believe, 2010. And when I came about buying this property, how it originated is a gentleman came to me and said, I want to sell this property. So he contacted us to evaluate selling the property for him. It turned out he owed the bank about $450,000 against this property. And this was, again, kind of at the bottom of the real estate market. Property was in really rough shape inside, really poorly managed, really low rents. And in short, he owed more than the property was worth, okay? Which is a situation many people were in 2009, 10, 11, etc. So most people, and I was, I believe, somewhere around the 6th or the 7th person he had called to help him sell this property. And most people told him they couldn't sell it. He owed $450,000. Wasn't worth that much, and I told him, let me see what we can do. Let me talk to your bank. So started talking to the bank and started negotiating a short sale, something we have done thousands of. And his bank happened to be Fulton Bank or Lafayette Ambassador Bank. So I negotiated with Lafayette Ambassador Bank to allow me to buy this property for $325,000. He owed the bank $450,000. So I spent months and months and months negotiating this sale. The client was thrilled and happy. He was going to get out from under this property he was losing money on. And about a day or two before closing, the bank said, sorry, looks like the sale is not going to happen because we want the buyer to sign a deficiency judgment. Who knows what a deficiency judgment is? Some of you realtors in the room, right? So that means that he has to agree to pay the bank back what he shorts them. So if I buy it from him for $325 and he owes $450, he owes the bank back that $125,000. He said, no way, I'm not signing that, I'm not agreeing to that. So the bank said, sorry, then we're not letting you out from this loan. So sale fell apart. I continued to follow up with the bank, see if anything changed for them. They kept saying, no, nothing we can do. We need this deficiency judgment. So finally I said to them, what if I just bought the loan from you? And I'd never bought a loan before. And they said, yeah, we'd be interested in that. What would you pay? And I said, well, I'd pay you $225,000. They said, okay. Then I said, how about you finance me $200,000 of that? And they said, okay. So the day I bought that loan from the bank, I went and met with the seller and he signed over the property to me. And I actually still own that property today. So I ended up buying the property for $225,000, $100,000 less than what I had agreed to pay it before. And guess what? The bank did not get a deficiency judgment from the seller. So that just shows our creativeness, our ability to create solutions. Thank you. When a lot of organizations and banks, just aren't willing to think and look for innovative ways to make things happen. And so many of our first acquisitions, so many of our first investors came from just looking for solutions to people's problems. Most of our first investors came from people telling us they couldn't find a place to earn a return. And I was saying, we can help you with that. Literally just happening that way. No marketing, no DLP Capital Partners at the time, etc. So our track record since that first apartment community, we have 0 months of missing our fixed or preferred returns on any of our investment strategies. We have 0 losses to any investors, as you heard earlier. And we've generated double-digit returns on all of our equity strategies to all of our investors every year, exceeding our return targets in every fund. One of the reasons we've been able to do that is through our consistent ability to grow and run our company effectively. We've been one of the 5,000 fastest growing companies in America for 6 straight years. We grew by 308% over the last 3 years. We've been able to maintain a 300 to a 400% growth over every 3-year period of time for the past decade. We were the 10th fastest growing company in America out of all companies in all industries that made this list 5 times or more, because we've been able to maintain very consistent growth. That consistent growth has led us to what you see on the screen today, or there today. We have over $575 million in assets. That's real estate and real estate-backed loans. We have provided, again, exceeded our returns to all of our investors. We provide housing to over 20,000 people. We provide funding to over 200 entrepreneurs. We have over 500 investors, over 100 of which are in this room tonight. Again, 0 losses. That slide was not updated. We now have 301 team members, and we generate over $100 million in annual revenue in our companies. So you might be saying that all sounds really good. Did I miss the boat? Why am I here tonight, right? I'm not one of those existing investors. I wasn't part of this growth. Well, we're still expanding, and that's why we're one of the many reasons we're here tonight. That says, if you can't read it, this company simply must do something about the office space problem. And as we announced a little earlier today, we are actually moving our offices to a new building across from Wegmans on 512 for this exact problem, because we don't have enough space. So we're expanding, we're growing. So by 2022, which is a little over 4 years from today, by the end of 2022, we'll have over $2 billion in assets, about 4 times our current size. We'll be providing housing to over 40,000 people, funding to more than 500 entrepreneurs. We'll have over 1,000 investors with us, and we will still have, even though this is going to be through some sort of market recession, 0 losses to investors and 0 months of missing our return targets. And it's probably conservative to say, since we just broke 300, we'll have over 400 team members. So quick bit about us, and let's get into the investment strategy. So you got to meet Bob briefly there a minute ago. Bob is our CFO. Barry DeGroot is our chief legal counsel. They are also partners in DLP Capital Partners. You can invest with us. We consider ourselves, and many do as well, institutional quality, meaning you can invest through us through institutional platforms such as Charles Schwab, Edward Jones, Fidelity, etc. We have multiple wealth management firms who allocate their clients' money to us. We operate in those places there. As you see on your screen, our office right down the street, 701 West Broad Street in Bethlehem, is our company-wide headquarters. We have a Southeast headquarters in St. Augustine and 3 other satellite offices. Over 500 investors. That green is where we operate, where we do business. I know you probably can't read it, but the yellow and black numbers tell you how many loans and properties we own in those various states. This little map, I'm sure, again, you can't read it, but that shows you each one of our apartment communities we own. So it gives you a little idea where those are located. So why should you be interested in DLP Capital Partners? In addition to the returns and our ability to mitigate risk, is transparency. All of our investors have access to DLP Crowd, where you can see all the information about all of our funds, all of our historical returns, the balance sheets, the income statements, the audits, everything you could want to see on any of our investment funds. So with that said, before I get into the first strategy, I'm going to invite one of our existing investors to tell you, who invest in this strategy, to tell you a little bit about his experience, and then I'll get into the strategy. All right, Tim, come on up. We'll bring you up over here. So round of applause for Tim. Come on up. First investor up. All right, Tim. So, you hear me on this one? Hello? No. Oh, there we go. All right, so Tim, how long have you been invested with us?
2 years.
Okay, so a little over 2 years. And which funds are you invested in?
I'm invested in the lending fund.
Okay. And why did you choose the lending fund?
I chose the lending fund because of the short duration of the loans to the investors. I felt that if there was a downturn in the market...
Talk a little louder into the mic.
I thought if there was a downturn in the market, I'd be better protected against any losses.
So invest in a lending fund because we make short-term loans to real estate investors, which mitigates long-term risk of the market changing.
Correct.
Awesome. So you've been invested with us for a little over 2 years in the lending fund. How has the lending fund investment affected your life in the past 2 years? And how are you looking at the investment over the next number of years?
Well, obviously the returns in any of the funds that you're looking at far exceed anything you can do with a bank or a mutual fund or a certificate of deposit. So it really helps you with your cash flow issues in retirement. So it's been great.
Awesome. So for anybody here who's not currently invested with us, thinking about investing with us, what would you like to tell them?
Well, if you're here tonight, obviously you have an interest in earning higher returns on your investments. As Don has pointed out in the slides, he hasn't lost any money in principal in the 13 years you've been in business. So I urge you to give this serious consideration. I doubt that you're going to find other investments that don't have more risk than this investment.
Awesome. Anything else you'd like to add about your experience with us over the past 2 years?
Absolutely. Don and his staff has really done an excellent job in helping me, in particular, my wife and I, analyze the different funds that are available. Okay? Helping us with an IRA transfer, helping us with an estate transfer, and then most recently, helping us kind of navigate the investor verify software. Many of you haven't gone through that. We had to do that because I didn't have a CPA certified in my network. I had to go through that software packages. So I want to give kudos to Mandy Danish, wherever she is. Bob Semenek, he helped us out. Elizabeth, the group with that software package. I could have never done that. And Larry Hinkenhell. Initially, when we came aboard, Larry was a great help. I believe he's down now in Florida. I envy that location.
Awesome. Awesome. Thank you, Tim. Anything else?
No, that's pretty much well. Again, I hope you seriously consider the investment. I think it's very worthwhile.
Awesome. And Tim's sitting up front, so feel free to chat with him a little bit. I appreciate that very much. Thank you. All right, awesome. It looks like dinners are coming out here, so again, feel free to eat as we get going here. All right, so when we talk about our two strategies, I said we have two different things we do here. We make real estate loans, real estate-backed loans, which I'm going to talk to you about first. So we make loans to private loans to active real estate investors, not to homeowners, to real estate investors. If you want to talk to one of those investors, there's one here in green, one of our very best investors. He'll tell you all about working with us on borrowing from us and working and partnering with us on investing. So our loan to value ratio, I'm going to get into a little bit of why you should be interested in this, how we go about mitigating risk. So our loan to value on average, who knows what loan to value is? Okay. So that means the amount we lend against the value of the property on average is 55%. Okay? So who wants to take a stab? And I know some of you know this. I'm going to try to only allow prospective investors. What's the average, what's the most common loan to value on a loan to a home buyer today? You can shout it out if you like. 78? 35, I heard? 80? 90? The most common form of financing is called FHA financing. It's 96.5%. Plus, you can roll your closing costs to get 102% financing. So we're lending to active real estate investors at 55%, a little different than the typical risk in lending money against homes. Our average loan to cost is 73%, meaning the borrower, the investor, put about 27% of all the costs, the purchase cost and the renovation cost, out of their pocket the day of closing. We focus on lending on investment housing against single family and multi-family properties that are in general income producing properties. Again, we lend to strong investors, strong borrowers. So we do a thorough analysis of our borrowers, credit check, background check, full analysis of the financial and the investment. Our average borrower has close to a 700 credit score. Our average borrower is worth about $3 million. Our average borrower has $300,000 to $500,000 of liquidity. So these are good bankable borrowers looking for fast, easy to deal with partner to provide them with capital to acquire short-term investments. We do not loan to this person. So most of you aren't going to read that, so I'll read it to you. I can't read it from back there either. It says 12,000 Twitter followers, 25,000 subscribers on FeedBurner are certainly impressive, but they aren't what we in banking business call collateral. So we lend against good collateral to good borrowers with assets. So how we mitigate risk to borrowers? In addition to lending to good borrowers, we go out and physically inspect every property we lend on. We put eyes on that property. Hans, where's Hans at? There's Hans. Hans ran our construction company for a number of years, oversaw all of our renters. Yes, that was a heck of a job. And now he oversees all of the inspection and scope of work and renovations on every loan we make. So making sure that they have a valid scope, make sure that they accounted for all the repairs that need to be done, and we're holding back enough money to finish that renovation. So here's an example of a loan that we made. So you see that's what the home looked like when we got started. Dated kitchen, torn apart bathroom. I know it's a couple of pictures a little hard to see. Semi-gutted house. That's what it looked like before. So this borrower had a 756 credit score, had a net worth of $600,000. We made a $180,000 loan. The property had a value of $305,000. So our loan to value is 59%. Here's what the property looked like at the end. So a full renovation was about a $50,000, $60,000 renovation, brand new kitchen, modern finishes, nice new bathroom, hard surface floors. They sold it in under 6 months. We appraised it at $305,000. They sold it for $320,000 in just 17 days on the market. As you can see why in those pictures. Here's another example. This is a home in Tampa, Florida, 4 bedrooms, 2 bathrooms. It's a little bigger than it looks, 1,900 square feet. That's what it looked like before. I don't have inside pictures here, it looks like, yes. So this borrower has 2 rental properties, has flipped a few, had a 785 credit score, probably a better credit score than many of us have, so pretty darn good credit, bankable client. $168,000 loan on a $240,000 property. And here's what the house looked like at the end. So here was this yellow, dated looking house, completely redid it, beautiful inside. Again, kind of similar to the other houses. Many investors have learned what buyers like to see. So very similar modern inside of that house. And so this property was sold for $240,000. We praised it at $240,000. Completely remodeled top to bottom. And sold it again in under 6 months on the market. Those are what our typical loans look like, typical types of houses that we lend on. This says here, if it would be this easy to flip a house. So a little joke on flipping houses. A lot of people think it's really easy and want to become home flippers. We lend to experienced people who know what they're doing. All right, so how do you invest in this strategy? First, you can invest as an equity investor or as a note holder. So as an equity investor, one of the things that's very attractive on this strategy, due to the fact that our loans are short term, is you can redeem your investment with just 90 days notice. So you're only committing your money for 90 days. It has a return target of 11%. It's 11% net to you with a 10% preferred return, which means you earn 10% before we earn anything. Here's the track record. We have now outpaced our projections for 59 months. I know you can't read those numbers, but the light green is the target return of 11%. The dark green is how much we've exceeded those returns each month since the fund started. So every single month we've exceeded the returns in that fund. For an average over the last, just coming up this month is year 5 of over 14% when the target was 11. Over the past year, we've averaged right about 13% net to investors with monthly distributions and 90-day liquidity. That fund is called the DLP Lending Fund. We have a second fund which is very similar called the DLP Income and Growth Fund. There's essentially one main difference between these two funds. The Income and Growth Fund makes loans in which DLP owns some of the properties. The lending fund does not. So some look at that as a really big positive, that we own and we're the one guaranteeing the loans on many of the loans in the Income and Growth Fund. This fund has been open for 33 months, has exceeded the return goals of 11% every period, and has averaged 12.3, 12.4% over the past little under 3 years. So those are the two equity offerings, or you can invest as a note holder. As a note holder, you lock in for a fixed return, meaning you know exactly what your return is going to be. You can take distributions every month, and you can commit for just 90 days, 3 years, or 5 years. Your choice. And based on how long you commit and how much money you invest, you'll get a fixed return of 6 to 9% paid every month. That's net to you with no expenses out of those returns. Or you can let the returns compound and grow, and that shows you what the return would be compounded on a monthly basis. You can also utilize in any of our funds your IRA, as Tim mentioned. You can invest through an IRA, an old 401k, even some pension funds, that says there, this is our retirement plan. So we can help you plan for retirement and get good, consistent returns into your IRA month in and month out. All right, so I'm going to bring up, and I apologize, Ray, if you're eating. I'm going to bring up our second and last investor, and then I'm going to explain the multi-asset strategy briefly, and we will then take questions. So a round of applause for Ray as he makes his way forward. Good behind. All right, Ray. So, how long have you been invested here with DLP?
No, it's hard to believe, but it's been over 5 years, maybe 5 to 6 years now.
Yeah, it's been a long time. Ray was one of our early investors, and since you started 5 or 6 years ago, what have you invested in with us?
Well, so the short answer is yes. I've invested in everything. You might recall, as we started, I was looking to invest in townhouses, and somebody said there's a new guy kind of around in Bethlehem. And you don't even have to buy a house, you just lend him the money, he'll do a townhouse, and he'll give you a 10% return on your investment. And I thought to myself, I'm getting 1/10 of 1%, that's 100 times what I'm getting back. I said, this can't possibly be. So I go over and respond, he said, yes, 10%, we're going to take your money, we're going to invest it, you just loan me the money, you sign over there, come back and pay it, and then at the end of it, when it's all done, the house will be Then he said, oh, but if you want to, before you turn that money over, I got 2 more houses that are like this. Why don't we do 2 more? So I said, that's pretty good. I found some more money, lift up my mattress, and then he said, you know what? We're thinking about putting a fund together, like a loan together, where we could just do a bunch of these things. You don't have to go to individual houses. I said, that sounds pretty good. I'll do that. So we put about $600,000 into that. And then he said, we're doing another round, so maybe I'll put another $500,000 into that, another $50,000 into that. And then he said, we've got these other funds, the fixed and the income and growth fund. So any of the money that I'm making on the investments goes to each of those getting 10%. And so I just cannot believe, this was a time when I started, people were talking about Bernie Madoff. Who remembers Bernie Madoff? So it was like, this has got to be a Ponzi scheme. This has got to be a Ponzi scheme. I said, Don, is this a Ponzi scheme? He said, it is not a Ponzi scheme. I'm doing this. Let me show you the houses that we're doing. Every house I've ever invested in, I go up and I see the house, and it's a house, it's a real house. So let me look at people who are doing private management, who are actually running these things. I'm putting in vertical integration and stuff into it. And this is the stuff I was doing at Lehigh University in the consulting we were doing real estate. We said, I was doing 7% of all this active, and I can do nothing for 10% and even getting a better return. I was working with Lehigh, and I just kept putting money in, and I've just been very hard to keep up with Don over the last 6 years.
Awesome, awesome, thank you. So you kind of already answered my question. Yeah, thank you. Go ahead. So, and to kind of give a little insight there, so Ray's in just about all the funds. He's certainly done a lot of investments in the multifamily strategy we're about to talk about, as well as the lending strategy, and then a bunch of other projects with us as well. So you've already kind of told a little bit about your experience. You've been able to sell off all your active real estate, invest passively, focus on your business. How else has the investment with us over the past 5 or 6 years affected your life, and how are you projecting it to affect things moving forward for you and Sue?
Well, what can I say about making 100 times more than I was able to make on my own? It's dramatic for me. It's actually given my mind the ability to retire. I'm 57 years old and I can actually retire now. Except I don't want to retire. I just want to be able to use that money to do more things. So we do want to travel. We do want to have kids in college and stuff. But one of the things, Don, is he treated me better than I treat my own customers in my businesses. And I just couldn't believe how good he treated me. And from that, I was able to generate enough money from the real estate investments now to be able to retire now. That's enabled me to put more money into my own company to kind of grow and take care, just in general, about the impact that I can have positively in the Lehigh Valley and beyond.
Awesome. So you've already kind of said, any other last remarks you'd like to tell any prospective investors thinking about investing? And before you answer, I want to first give Ray a big thank you, because many of his family is tonight, who he brought into the room, but also has referred many investors to us and spoken to a number of you before you invested as well, telling you his experience. He's been with us, one of our longest standing investors, as well as his brother Andy and Tina over here as well. And some of you talked to Andy in the past. So first, thank you. So you've already done a ton, but what would you say to any prospective investors here tonight?
Well, just as Donald Trump has been able to say that he loves Kim Jong-un, right? I really want to be able to tell you that I love Don. I've never met anybody like Don who is transparent, does exactly what he says he's going to do, and he has put his entire resources at my disposal. When we had to turn over all the real estate from Lehigh University properties, he had us with lawyers who were helping us with 1031 exchanges, and he's just just been a very generous, caring, giving person, and it really embodies the kind of organization that he says he wants to be. He really comes with the man, and I just really I just can't say enough about Don and his organization. I'm just
thank you, Ray.
Taking notes on everything you're doing.
Thank you. Thank you very much. Round of applause for Ray. I think I'm done for the night. Thank you. All right, so as you guys finish up here, I'm going to talk a little bit about our multifamily strategy, and then we'll be opening it up to questions. So raise your hands here if you like giving Uncle Sam 1/3 of your returns. Wow, maybe if I have everybody stand up, we'll get a different result. Right? Obviously nobody's going to raise their hand for that. So you'll like this strategy here. We buy apartment communities. We buy value-add apartment communities. We're very focused today on what's called Class B communities, which we'll talk about. And we focus on buying properties that need improvement, which I'll show you in a second. Again, you won't be able to see all these probably that well unless you're sitting close, but all of these are in the brochure that you have. These are some of our apartment communities we own right now. We own over 8,000 apartments right now and growing. all throughout mainly the Southeast, but some here in Pennsylvania and New Jersey. We're about to buy our first property in the Midwest, South Bend, Indiana, but mainly throughout the Southeast. So in the lending fund, I talked about how we lend to good borrowers and low loan to values and low loan to cost, or how we mitigate risk. Here in buying properties, how we mitigate risk, first of all, is strong in-house management, meaning in-house property management. Here are some of the leaders, some of the smiling faces of the people who drive results in our property management company. We employ over 150 people in our property management company out there in the field, working at the properties, working on the communities that we own, driving results. Plus, we employ another team of individuals at DLP Builders, which oversees the construction and renovation of the communities that we own. So how do we mitigate risk here above and beyond great management? Is disciplined buying. So I'm a big believer that you make money when you buy something, not when you sell it. You get the value out of it when you sell it. So we focus on buying properties at very good prices, not paying today's prices, which we can talk about how we do that. Next way we mitigate risk is through long-term, non-recourse debt. Especially right now, it becomes very valuable as interest rates are rising. We lock in our loans so that our rates don't go up on us over the course of our loan, typically 10 years or 12 years. Our loans are 30-year loans typically, but the rate is locked in for 10 to 12 years. Our current average loan to value as the owner is about 55%. This here shows you the funnel of how we go about finding properties. We look at hundreds and hundreds of deals every month to buy one or two. It takes us hundreds and hundreds of hours, a good amount of money, lots of time and effort to find the properties we buy. They're not sitting out there. You can't just find the kind of returns and deals we buy. It takes a lot of effort and energy. We have a whole team focused on acquisitions, analysts, out underwriting, looking at deals, people out in the field, physically out inspecting properties. We have people out in the field right now in Mississippi and Georgia out inspecting potential properties today. Then once we find these good deals, we then typically have to come in and add value. So meaning we improve the management, improve the occupancy, increase the rents, and that usually requires us to do renovations. Usually we're adding amenities, we're improving the inside of the units, the outside. So this is a picture inside of a unit. This is a local property, to give you an example. This is an apartment called Belvedere Apartments in Nazareth on Belvedere Street, as you might guess. When we bought this, it had a tattoo parlor and a laundromat on the first floor, and 9, maybe you would call them apartments, on the second and third floor because the bathrooms were across the hall. The rents were about $350 a month. This wasn't 1990, this was 2012 or 13. And it was in rough shape. So we came in there, we gutted this property top to bottom. It looks like that now on the outside. All new, brand new kitchens that look like that. All fresh inside, all separate utilities. And our average rent now today is about $925 a month. We took this value from $330,000 we paid for it to about $1.8 million today. And we're going to sell this soon. So actually, if you're looking to buy it, the value is about $2.2 million. But that was an example of a property we renovated. Here's a more typical example of properties we bought over the last couple years. This is a community that were all very similar. They were built by a builder called Cardinal Builders. They're all these single-story apartment communities. They're all exactly the same inside. Unfortunately, when we buy them, many of them are exactly like that, with gutted kitchens and mildew, I won't call it mold issues, and in rough shape. So we come in there and we clean up the outside, we put in new kitchens, hard surface floors, freshen them up, and we on average increase the rents $150 to $200 a month on each apartment once we come in there, often more on the ones that we do full renovations like this. Here's a property we own in Brunswick, Georgia. When we bought this property, as crazy as this sounds, there were 40 apartments that looked like this for 10 years. They weren't rented for 10 years. They sat there like this. So we came in there, we renovated all of these apartments. They all look like this now. and increase the value on this community from about $5 million up to about $10 million over the past 18 months. So why do we invest in multifamily? Well, first of all, why we invest in housing is because rentership is on the rise. Who's surprised to hear that rentership is on the rise? More people are renting today. Anybody? A couple of you? Yeah. So it's been happening for 10 years now. Rentership continues to climb and home ownership continues to decline. Family formation is happening later in life. People are buying their first home later in life. And a lot of people say the millennial age has the least interest in home owning as any generation. And a lot of the baby boomer generation don't want to own anymore and want to rent as well. So it's creating a big demand on housing. We like to invest specifically in the Southeast because there's strong demand, there's strong job growth, and strong population growth. So who in this room is thinking about moving south at some point? Right? Who has friends and family who have moved south recently, right? It's not a surprise, right, to hear people are moving south, right? We expect that to continue, and that's going to create continued demand, and that's where the jobs are going. North Carolina, South Carolina, Georgia have phenomenal job growth. We go into secondary and tertiary markets, meaning we go into smaller markets. We're not often in Miami and Atlanta. We're more in Warner Robins and Titusville. We're in secondary markets. We go there because there's less investors there, so there's less competition. We can get better returns. And we like our portfolio being diversified across lots of markets, so we're not dependent upon one or two big markets. We like to buy Class B properties that are typically not luxury in quality. They're typically built before the year 2000, and they typically don't have all the luxuries and amenities of the brand new or Class A communities. Take a guess, and our existing investors, I told you this at the happy hour, so please don't give away the answer. For prospective investors, take a guess at how much rents have increased in Class B housing over the past decade. 10 years, from Q3 of 2008 to Q3 of 2018. You need to shout it out.
50%.
50%. Any other guesses? 75. So he was pretty accurate. 54%. So think about that. From 2008, which was considered, 2006, 2007, 2008, kind of the peak of the market, right? To now 2018, rents have gone up 54%. If you were paying $1,000 for rent, now you're paying $1,540. How much do you think incomes have gone up over the past 10 years? 54%? Anybody would guess that, right? No, of course not, right? Not even double digits. It's actually for the lower 75% of wage earners. So if you remove the top 25% of wage earners, total income, not adjusted for inflation, just pure average income, has gone up 3% over the past decade. So rents have gone up 54%. Incomes have gone up 3%. So could you see why there'd be a demand for affordable apartments, not for the luxury apartments, when incomes aren't growing, but the cost of housing is? It's creating a great demand on affordable apartments, $700, $800, $900 apartments. And then, so there's a lot more demand. People can't afford luxury. People need to have an affordable place to live. Populations are growing where we're investing. Take a guess at how much of all the new homes that were built and apartments that were built in the past decade were Class B, were affordable. Any guesses? None? Correct, none. So the demand is increasing for affordable housing, but yet there's no new product out there. Nothing's being built because you can't afford with the cost of building to build an affordable apartment. You need to rent your apartment for $1,500 a month to afford to build it. So if there's no new supply being built, there's an increase in population, an increase in demand. Anybody think that's probably a good formula if you're investing in that strategy, right? Supply and demand. So there's more demand and no new supply. And we believe when there's a market correction, because of that supply and demand, rents are going to remain strong and occupancy is going to remain strong. We think rents will actually continue to rise a little bit more modestly, but actually go up when the market's going down because of the demand for affordable housing. We think people will go out of the luxury apartments and create even more demand for the affordable apartments when people are having more unemployment and more instability. Here's an example of the last apartment community we bought, or one of the last we bought. It's a community called Prosper Azalea City. It was called, I don't even remember what it was called now. We focused on our branding so much. Arbitrage, there we go, Jason. Oh, I didn't see Jason. Jason, our COO over here. I didn't call him out before. So Jason, our COO, who also oversees our property management. We bought this property called Azalea City in an auction. It's a 300-unit apartment community in a town called Valdosta, Georgia. Anybody ever been to Valdosta, Georgia? Oh, a few people. Okay. So Valdosta, Georgia is in the center of Georgia, at the bottom of the state, 2 hours from Jacksonville. So this was 300 apartments owned by a loan servicing company with about 16 units that were fire damaged and not rentable. It did have some nice amenities. It's got a new clubhouse. It has 2 pools, nice space, got a park area. So we paid $11,392,000, which is a $37,975 per apartment. The expected returns on this property are a 23.7% annualized net return to investors over the next 5 years. We'll generate 10, 11, 12% cash-on-cash returns on the property. Plus, we're going to get some proceeds back from refinance. So we bought this property at $38,000 per apartment, when the market prices right now are about $60,000 to $65,000 an apartment. So it was a phenomenal deal. And this is the first community purchased in our new fund that I'm going to show you in a second, called the Preferred Return Equity Fund. So the fund's off to an incredible start with a steal of a deal in the fund. Here's what some of the inside of the units look like. So they're in good shape, good, nice, basic units. But we're going to go in there and start renovating kitchens. We're going to put in new hard surface, new cabinets, replace some of the cabinets, new flooring, new lighting. And we'll take the average rent today of $609 up to about $750 and over $800 for the renovated units. Still very affordable. So how you invest in this strategy is the DLP Preferred Return Equity Fund, what we also call the PREF Fund, which is the initials for Preferred Return Equity Fund. So in this fund, it's a little different than our lending fund. In this fund, you're coming into this fund looking for a longer term investment. So you're going to commit to this fund for 5 to 8 years. You can redeem out early if you need to. It has a 180-day period you can redeem out. But you go into this fund if you're looking to be in a longer term investment. The goal is to distribute out 8% return net to investors on an annual basis, paid out quarterly. So in other words, you invest $500,000. Our goal is to distribute to you $10,000 every quarter. And then at the end of the fund, in 5 to 8 years, to return back 150 to 200% of your original investment. All the while deferring tax as we pay out distributions. Almost all of the returns, if not all, are going to be deferred from tax. And then when the time comes to actually pay tax, you're going to pay long-term capital gains instead of ordinary income. So very tax advantageous, great place to earn consistent returns. Overall return target is north of 12%. Expect really to be in the mid-teens net to investors. I know what you're thinking, wow, this sounds great. How do I take action now? So we are not here to sign anybody up today. If you're interested in any of these strategies, you can reach out to myself, Bob here standing next to me. You can also talk to Mike, our Director of Development here as well. And then Larry, as people mentioned, Florida, he's actually here in Pennsylvania. His brother's getting married tomorrow, so he's busy in the wedding. But you can also reach out to Larry if he's your contact as well. Or you can also go to dlpcrowd.com, which is our investor portal, where you can see the actual financials for all of our funds, the balance sheets, the income statements, the assets we own, the audits from the auditors, everything you could want to see to get comfortable and learn about our strategies. Upcoming events. So after this event here today, we have 2 events coming up. So the next event here will be January 3rd, right after the new year. You get to come out and celebrate the new year with us. January 3rd, right here, Thursday, same time, same place. Easy to remember. We'll of course get emails and notification and mailings out to everybody. And then if you'd like to come join us, which is really nice to come join us in January, come join us in sunny St. Augustine, Florida. Our next event there will be January 17th at the Palencia Club, where we hold our dinners there. Many of you have already come and joined us there. Who here in this room has come down to St. Augustine to visit us? Quite a few. Raise your hand there, bud. Quite a few of you have. come down and visit us. So please do. We'll put you up in one of our beautiful places and come get to meet some of our Florida investors and soak up some sunshine. All right. So with that said, I'm going to take a moment. We're going to come around. Actually, we're going to do this afterwards. We're going to come around and do questions, and then just stay around after questions. And we're going to do a raffle where we're going to give away weekends at St. Simon Island, Georgia, an incredible oceanfront condos, amazing, relaxing place. Come down and get some sunshine this winter. So we're going to give away some vacations there after we open it up to questions. So with that said, Brian has the mic over there. Simply raise your hand and he'll come over to you to answer your questions. Thank you everybody for your patience. Feel free to get up and get a drink, but please try to keep the conversation low so people can hear the questions. So go ahead, Brian. Thank you. There's no way I'm getting off this seat. Jim. Oh, want me over here. We got your mic here. Want to take mine?
I need you to stop by my house and talk to me.
Will do. This is Jim Faust, might know him from Faust Home Builders, Faust Construction. Will do, Jim. Questions? We never get let off this easy here, Brian. All right, here we go.
Can you just briefly discuss the investment thresholds? Do you have thresholds as far as minimum amounts?
Great question. So what is the minimum investment? So two topics I realized I forgot to talk about. One, as for what is our minimum investment, in our fixed notes, which are the 6 to 9% fixed notes, the minimum investment is $100,000. For the DLP Income and Growth Fund, the minimum investment is $250,000, as is the Preferred Return Equity Fund, and the Lending Fund is $500,000. We look at that as your overall account size, meaning if you invest $500,000 with us, you could allocate that as an example across multiple strategies. The second thing to mention is accreditation. So Tim mentioned a little bit about this earlier. So in order to invest in our funds, you must be an accredited investor. Who knows what an accredited investor is? Many of you do, right? You probably know from us recently as we had to update accreditation forms. So the definition of accreditation means you have $1 million in net worth, not including the home that you live in, or a $200,000 annual income, one or the other. So that's the qualification to invest in our funds. If you don't meet those qualifications, if you're not sure if you can still invest in private notes with us, even if you don't meet those qualifications of accreditation. And we can talk to you about that, as a number of investors in here invest in those notes who don't meet the accreditation status. So great question. Thank you. So I think we're getting a question. So this event, I forgot to say this, so this event's been live streamed online. We have many people watching this, investors around the country and prospective investors. So it looks like we have a question online that Brian's going to ask me here. So you guys are all famous now, especially if you've been sitting in front of this camera.
So question came in from online. Can you explain the difference between cash on cash return versus long-term delivered return to an investor?
Yeah, great question. So in our lending strategies, all of the returns are cash on cash, meaning we pay out all of the returns every month or every quarter. So when we say we're generating 12, 13, 14% returns, we're paying those out on a monthly basis. In this fund, the Preferred Return Equity Fund that we own real estate, we pay out a target of an 8% cash on cash, meaning that's what we pay out to you while we manage the properties from the rental income. Then when we sell the properties, we return back the rest of your money plus all the additional profits, which brings your overall return to over 12%, as our goal is to distribute back to you 150 to 200% of your original investment, plus the 8% or so you earned throughout the investment. So great question. So
Hey, Don. You mentioned before dinner some of the funds have a little bit of leverage in them. Are some of the funds more leveraged than others? What's the difference?
Yeah, great question. So the question was about leverage. So when we own the real estate, like the fund on the screen here, when we own the apartment communities, we borrow money typically from, actually the government, from Fannie Mae and Freddie Mac, loan programs out there, agency lending. On average across our portfolio, we have about 55% debt against the real estate we own. So if the property's worth $10 million, on average we have a loan for about $5.5 million. And then our equity is invested essentially behind that. Although in this fund, which is something I forgot to mention, in this preferred return equity fund, your equity as an investor is preferred equity. What that means is every property we buy, there is common equity. The difference is every property we buy, so in that example, the property is $10 million, we have a $5.5 million loan, we have to invest $4.5 million equity. At least 25% of that equity, so at least $1 million of that equity will be common equity, meaning that equity, the preferred return equity, the investment fund get their cash flow, their return first before the common equity. And if there was ever money lost, the common equity would lose all of their money before a preferred return investor could lose 1 penny. So there's equity invested behind the fund, protecting and insulating the fund in case of any loss, or if there's not enough cash flow, the preferred fund gets all of the cash flow. So that's when we own the real estate. When we own the loan, our lending strategies, so I'll talk the lending fund specifically, we borrow money from a credit facility, a couple different credit facilities, meaning they provide us with leverage against our loans. Currently, right now, our leverage is between 25 and 30%, meaning for every dollar of leverage, we have about $3 to $4 of equity. Our goal when we set up the lending fund was to be around 1-to-1, between 40 to 50% leverage and 50 to 60% equity. So $1 of leverage or debt to every $1 to $1.50 of equity. We've never gotten that high yet. Our highest we've ever been at is where we're at today, about 25 to 30%. And that leverage does two things for us. Number one is it helps us manage cash flow. So we don't have to keep cash sitting in the bank, draining, not earning returns. We pay down the leverage. We draw on the leverage, meaning we borrow money as we need it. And then the second thing it helps us do is increase your returns. Because when we're borrowing from our leverage facilities, we're paying 5 to 6%, and we're charging the borrower on average about 11.5%. So we're earning that leverage, which helps us generate the 13% or so return net to you. Answer your question? Oh, one more?
Is the general partner on the hook for the leverage?
Is the general partner on the hook for the leverage?
Or do you have SPVs or something?
So short answer is you are the limited partner. So you have no liability to any debt, no personal liability, and we don't have personal guarantees on our leverage facilities either. So there's no personal guarantees for that leverage. The fund itself is responsible for paying back the leverage, which is one of the reasons we keep leverage so modest in our eyes. Answer your question?
Well, someone's ultimately, if Fannie's owed 55%.
Oh, so you're talking about the multifamily side. So I was talking about the lending strategy. So when we borrow money from Fannie Mae or Freddie Mac, there's no personal recourse to anybody. So that means if the property went completely south and was worth not $1, we could walk away from the property and the banks couldn't come back to us for anything personal. They could take the property, but they can't come after anybody personally. It's non-recourse lending. Again, we don't lend non-recourse. When we lend to borrowers, they sign full personal guarantees. We think it's very valuable. When we borrow, we don't want to sign personal guarantees.
Early on, I saw you had reference to some of the major brokerage houses, DLP, Schwab, etc. You invested in these funds through those brokerage. I have assets, whatever, DLP or Schwab, which I invested in. How does that work? I can purchase the fund through that?
Yes. So example, Charles Schwab. If you said, hey, I have money at Charles Schwab, you could allocate money to us in your Charles Schwab account, just like you could buy a mutual fund. It's a little bit more difficult. It takes a couple days. It's not an instant thing. It takes a couple days and slightly different paperwork. But yes, you can invest money, and then it'll show up right on your Charles Schwab account, just like any other investment. We report to Charles Schwab as an example every month. We update your account balance, and you see it on your statement or your login, just like any other investment you have.
Great, thank you.
Great question.
Do any of your instruments are all allowed for a rollover proceeds rather than cash disbursement on a monthly basis so you can compound? Is that allowed in any of the programs?
Can you say that question one more time? Sorry.
Do you allow for the rather than cash disbursement every month? Will let that roll over and compound? Is that in any of the programs or all?
Yeah, great question. So in all of our lending strategies, the income and growth fund, the lending fund, you choose every month. Do I want to take my distributions or do I want to let it reinvest? You can change at any time, and you can do a combination. Some people say, hey, I want $2,500 a month. I want the rest to reinvest. And although Bob and Dan, our accounting team, don't love when I make it really complicated for them, we can absolutely do so, and we do it all the time. On this fund, the preferred return equity fund, we own real estate. If we're in the investment period, if we're still making investments, yes, you can keep reinvesting. If we stop making investments and we don't have use for your money, then typically what we allow you to do is invest that money, roll that money into another strategy. So great question. How's the dessert? Good? Hopefully everybody's getting it here shortly. Cool. John. I was waiting for you.
Yeah, Don. One of the things that I heard in the earlier meeting was that for equity one, which I don't remember really, you're not going to be cashing in all the profits. You're only cashing in roughly 60% of those. How do we ensure the people that are cashing out? How do we ensure that they get the best results? And how do you determine the value of those results for the equity one?
Okay. So I'll probably have to answer some of this question one-on-one, but I'll give the broad-based question. So our first fund we opened was called the Equity Fund I. In that fund, we went out and we bought single-family homes, multi-family properties. We bought an apartment community we built in Stroud Township called Mountain Hollow Estates, and even some commercial properties. That fund has been open for a little over 4 years. This is year 5. And as we were getting ready to, as we are selling off the properties and returning people profits, we had a lot of investors who came to us and said, Don, this is great, but I don't really want the money back because then I have to pay taxes. So now once you take the money back, you got to pay your long-term capital gains. So we started thinking about saying, well, what do we do? How could we come up with a vehicle that you could continue to invest in since we want to wind down this fund? We don't want to keep owning all the single-family homes and such that we own, but find a way for people to defer tax. So what we came to the conclusion of, we did a survey with our investor and said, hey, if we had an investment vehicle for you to roll into, would you want to? And we kind of laid out some structure to that. And around 40% of the investors said, yes, I want to keep my money and roll it over and not pay tax. And around 60% said, no, I'm okay with paying a tax. And investors who invested via IRA money aren't worried about the tax because their money's sheltered. So a lot of the IRA money said, no, I'll take the profits. So what's happening is all the people who want to stay in the fund are going to be members of just Mountain Hollow Estates, which is a 139-unit apartment community worth roughly $30 million. And they'll own interest in that community, earn consistent returns, and lock in their buyout price now. Versus investors who want to get out, they'll be able to exit out here over the next few months and end up with what we think is a pretty great return. So as far as how we go about valuing every property, every quarter we report what we call an REO schedule. We report a list of all the properties we own and what they're worth. And that valuation, that updated report just came out today, tells you how much all the value of the real estate is, property by property, how much the debt is, what's our value, and then we divide that value over the number of units. And that's what really determines what the value is of each unit. So we can talk in depth to how each property is valued. Some are appraisals, some are us do an updated value, so we don't charge the fund for appraisals on every individual house. But that's the general rundown. So some investors are exiting out, getting all their original money back plus a healthy profit, which we calculated. Some investors came in at different times, but about a 20% return on annual return. And some are staying in and locking in for a fixed return moving forward and deferring tax. So I can get into detail more specific with you on property by property or walk you through the schedule of how the values were determined, but that's the somewhat short answer. So thank you. He always known for getting me a hard question.
Don, yeah, we've got another great question from the internet. Speaks to
from the internet.
Yes, from the internet. It speaks to the lending fund strategy. And the question is, if we are lending to these great investors, why are they willing to pay 9, 10, 11, 12% interest when they're bankable? They should be able to get a much better return from a bank.
Yeah, great question. So I'll first turn the question around to you guys in the audience real quick. Who has tried to borrow money from a bank recently? Anybody had a not desirable experience trying to do that? Right? I mean, it's very challenging. Banks are under so much federal regulation, it's hard for them to lend against real estate. More specifically, it's very hard for them to lend against income-producing real estate. Home mortgage is a little different because they just sell those mortgages to the government. But lending against income-producing real estate, they're really penalized to do it. They don't want to do it. It's very difficult, and it's very slow. I could go to a bank right now and say, I go to PSBT Bank where we have, well over $1 million always in deposit there, and say, all right, I'm buying a property for $1 million, and I'm going to put down 900 grand cash. I just want a loan for 100 grand. It'll still take me 45 days to get that loan done. I mean, it's just a painful process, and I'm their biggest client, so it's still difficult. So people come to us first and foremost for the experience. Oops, I'm sorry. For the speed and the execution. So they know we're going to show up. They know we can move quick. They know we're not going to make it painful and difficult. And then maybe even more important than that is that most of our investors expect that they're going to buy the property, renovate it, and sell it in 6 months. So guess what? The difference between a 6% interest rate and a 12% interest rate when you're only owning it for 6 months isn't that much money. We're talking $2,000 or $3,000 typically in additional interest to not deal with all the headaches, to not lose out on the deal because you couldn't get the loan done, to not risk your deposit. And then on top of that, we really try to bring them a ton of value. So people like Hans work with the borrower to help guide them on how to renovate the house, guide them on maximizing the scope, helping them get set up with contractors, helping them mitigate risk. We often help them find deals. We help them sell the deals. We help them when they get into challenges. We bring them a lot of value to the relationship. And if you want to hear that question, I guess the internet can't ask this question directly, but you're welcome to come ask Rocco over here why he borrows from us, despite he has many relationships with banks. When he renovates the house and rents it, then he goes to the bank and he gets a long-term loan at 5% interest rate and keeps the property. But when he just wants to renovate it and sell it, he comes to us to give him that short-term, easy, flexible capital. It's a great question. Anybody else? All right. Oh, one more over here, Bill.
When are you going to open up DLP Savings and Trust?
Short answer is we'll see. So when are we going to open a bank is what he's asking. So we'll see. I'll leave no comment there at the moment, but possibly at some point. So great question. Anybody else? All right, so we're going to do the raffle now. Are we ready for that? I think everybody came around. So we'll do the raffle now, and then I'll be available.